hear and see me, just let me know if you can't, because I think we had a slight technical error there. I'll give a sec. Gives me a chance to clear my throat and fill myself with more copious amounts of caffeine so I don't fall asleep. You're wondering why my glasses are reflecting, by the way. It's because they're special anti-migraine, anti-light ones. I think we're okay. I will refresh the stream. Are we okay? I think I can't see I'm disconnected. I think everyone's fine. So let's move on to yens. Yen pairs, you can see are dripping down massively. This is the kind of sentiment change that would be ideal if you saw it on gold. But really what's occurring is basically everything that has gone overnight. You can read summaries about this on the internet. But after a spike, Treasury bonds fell as Japanese debt was liquidated. There's a lot of news regarding Japanese bonds, the Bank of Japan. Their comments regarding inflation, achieving 2% trend inflation could be defined where a state economy shocks, and all kinds of news. Mainly you need to understand that what has happened is the yen has gained value against all its counterparts. So although you might not understand specifically the macro or microeconomics that are being discussed or involved, it doesn't really matter. Your job is to understand that, okay, the sentiment around the Japanese yen is positive. It's bringing down the alternate pairs. And therefore, what can we do with it? Now, I've called this short repeatedly. Go back on my profile. Okay, go back on my streams. I said specifically, okay, you've seen it fall here. So the evidence you're gathering is that the price has stretched to this point. It's got way more value for people holding it long. And they say, and I got an editor's pick on this because I called it last time. They say, okay, we've had enough of holding it. We see a change in sentiment. Maybe the Bank of Japan says something or something like that. Okay. And what happens is you get your retracement. Now, the reason why the retracement is so much further and such a large amount to 50% in a fairly short period of time is because you came up so quickly and you came up with such velocity of 50% or so that 50% really is quite reasonable. So I was saying, sure, you know, it's not going to go up forever. It's just not feasible to go up forever. If you have a major FX pair or anything with a reputable, stable economy concerned, you will not go up forever. It will fall at some point. If you're looking at an economy that's very unstable, maybe Argentina, the peso, or somewhere in Africa, Zimbabwe, then you may get persistent up moves with very little pullback. Everything pulls back to some degree, but you will always find people start to liquidate their orders. So what causes an oscillation in the markets is simply the liquidation of longs up here. People saying, you know what, my contracts are worth as much as I would like. I know the longer this goes on, eventually it has to stop, and they get short. They get short en masse, and what happens is the market falls considerably. And then it becomes your job to identify where you would like to relong the market. Where would you like to change your bias so you're now rolling with what is likely? So when you come to that same point again, why buy is my question. You get a very minor market maker stop, I would say, okay? Doesn't quite come above the previous high, so you might have been okay if you used a stop loss. That's completely up to you. I don't. But, you know, the point I was making at the time is you've seen it fall already. You know people prefer it short. You know investors, okay, who want to short sell the market or divest, in a way, I guess, and liquidate their long orders. You know they've done it already, and now you've got the chance to see it again. It doesn't mean it's certain by any means. Like I said with gold, you could have gone higher. You could have beaten the high, but it's your most probable bet. Okay, that is your most probable entry because you've seen it before. If you watch a horse race and the horse wins, what happens in the next race? The odds are lower. You get paid out less for the horse because it's more likely to win. In other words, people have got the evidence they need. They've seen something happen before and they make a future judgment on it. Trading is no different. Okay, that's how you establish what is a feasible long-term entry price. It's by looking at what you've seen, make the judgment in the future, do it with core risk management, and you have a long-term plan or long-term process. So that's why I called it short there. And if you had it short, I would kill it for gains, or at least lock in gains. So you're all clear on that. Now what's happening is you're pulling to an area of key weekly support, okay, which you can see there. So this becomes your new reference point. You already went off the basis that you had fallen previously up here, where I'm labeling. So when you come to the opposite side, what are you going to do? You're going to look where would be feasible to re-enter the market long, which comes at areas of price rejection, price action, okay? Because that is what forms the basis for any reversal in price, like I said. So what you can see happening now, and which is very much ubiquitous, you can see that you're getting minor rejection. So that tells you, okay, well, it's stumbling. Perhaps it'd be a good time to get long. So I'm long on the dollar yen, okay, I'm long biased, and this is why I hedge out the market, because it allows me to heal anything I got wrong previously. As long as I space it out, as long as I take light sizes, I have a long-term process. But this is an area where you're under your 100 MA, you're under your 20 and 40, you haven't pulled back considerably, and it's ideal to scale in long, in my opinion, okay? You're still well off your 40 MA. Okay, I wouldn't be surprised if your 40 MA nudges up slightly. And again, that would form the basis for further longs. So I'm using DCA. I don't know when it's going to stop. I don't care when it's going to stop. My job as a trader is to assign market value to my entries, space them out so I can survive the variant swing of the market, have reliable sizes, and make an overall trading plan. Okay? Plan being the key word. If you have no plan and you are just watching this and you're saying, oh, you know what, I'm going to buy, you won't make money. You will lose money. Even if you did that, you will lose money because you have no plans on how to deviate your strategy, okay? Which is paramount to success. And lots of people believe that making money trading or learning to trade profitably is just simply a case of jumping on and buying and selling because someone else is. It's not. There's management behind it. After the market moves, you've got to know what to do. So, like I said, that's why underneath I put a discount entry link, and you can go and get it there. So the other yen pairs are much the same. The fall on things like the Swiss yen is less considerable. However, you're still coming to early areas of key support. You can see that early price rejection. I wouldn't be surprised if you mizzle around and your 100 MA comes up slightly, but nonetheless, I'm long on these falls. I'm buying the impulse fall. I've seen the market come down and I want to get that long stretch back. Often, and as many of you know, just like you saw on gold, if you get a really fast rip up, many times you'll get a rip the other way because people rapidly liquidate, they change their bias, and boom, people get taken out the market who don't know what they're doing. People who do know what they're doing take advantage of that low price. They know how low the price is for that period, and they know, therefore, the likelihood of the rebound. So that is why I'm long biased across the board. Dollar yen, AUDJPY, it's all much the same. AUDJPY, for example, if I hold it on my dollar chart, you're right, you're 100 key MA, so you've got a good gauge for where the market is. And on top of that, you've got various areas of key support. Okay, you're coming off the back of 4 days straight down. And if you draw it with a ruler, let's say, you get 98 almost to 95, so a considerable way. So again, I'm looking for that impulse. I'm looking for people to rapidly change their bias. You can already see early signs of that, and you can see it there. So that tells me, wow, perhaps that's okay. Stock oscillator very low, and again, your stock oscillator is very low. So you shouldn't be selling it. If you're selling into support and you're selling after such a large move down, you're mad, okay? And I would really, really get checked out in that case because you're just selling into where people are buying. You're selling into statistically where people would rather buy, and it's not right. So don't be one of those guys. People ask me all the time, they say, Will, the market's crashing, it's coming down. Why don't we sell? Why don't we sell into support? Why don't we sell low prices? It's lunacy. What business sells low prices and buys high prices? None of them. Okay.